Ryan Kelley, it's been a rough year for the banks due to the low interest rate environment. But one bank you like at the Hennessy Large Cap Financial Fund is Bank of America. So do you think Bank of America can take advantage of Wells Fargo's misfortune at all? Maybe boost them up?
I think it'll take some time to figure that out. I think that Bank of America it's the largest bank in the United States by deposits. It is a very well-run community bank when it comes to the sense of them making loans and taking deposits. It's a company that's trading at 10 times earnings, so that's attractive to us. And also in a rising rate environment, we think that they'll do very well. If you see the Fed raise rates over the next year or two, their actual earnings are going to increase pretty significantly. In the meantime, I think that with the disruption at Wells Fargo, that does create some opportunity for the other banks as well.
All right, speaking of other large cap banks, you also like Citigroup. Now, Goldman Sachs downgraded Citi last week, says that earnings inflection point just didn't materialize. So why do you like Citi when Goldman has gone cold on it?
Well, really, it's been a tough tape this year and last year for financials, as you mentioned. And Citigroup is one of the cheapest right now. Out of the large cap banking space, it's trading at 9 times earnings. This is also a company that when rates rise, it's going to do much better. When the global economy gets better, they are more levered outside of the United States as well. So we think that over the long term, there is some opportunity to own this company.
All right, on the small cap side, you are also a fan of Independent Bank. This is up in Massachusetts. Stock's up over 10% this year, having a great year. They've been buying up other small players in New England. So what are they doing right that the rest of the industry is doing wrong?
I think what they're doing right is that they're focusing just on their local community. And this is a community bank which has been around for many years. We've owned it in our fund for many years as well. They're based outside of Boston in very good demographics with some good housing market. And for these smaller banks, that's really part of the story. They also are acquisitive. They acquired a nice sized company last year, and they continue to benefit from that. The management team has been able to run this at higher ROEs than the industry and higher ROAs. And we think that there's still more opportunity here, trading at about 13 times earnings.
All right, and then finally another small bank, PacWest, out in the Los Angeles area, has about a 5% dividend, so you're getting paid to wait to a certain extent.
You are, and this is a company that has done 2 transformative deals over the last couple of years. They bought 2 companies which not only increased their asset size by about 2-fold, but it also has put them into a higher profitability model where they're making loans that are achieving much greater returns for them. So we think it's a little bit more expensive than the rest of the banking space, but because of their growth, we like the company. And as you said, it pays about a 5% dividend yield while you wait.
All right, well, thanks a lot, Ryan.
Thanks, Greg.
And thank you for watching The Street.